Hello, I'm David McKinley. I'm the President and Chief Investment Officer of McKinley Carter Wealth Services. We're pleased to be with you today. We want to share a bit around what we are, what we see in the world and what we're doing in client portfolios. Just as a quick introduction for those that are not as familiar with McKinley Carter Wealth Services, we're an investment advisory firm registered with the Securities and Exchange Commission. We are fiduciaries, and we're overseeing approximately $2 billion for clients across for some 1,600 clients all across the country. And I want to emphasize the fiduciary status. We're always focused on the interest of our clients, putting them first. Among the things we do and the way we serve clients is through our Investment Services Council. And today is going to be a focus on our investment program. In fact, there are 6 of us that contribute to our overall strategy. And we're a seasoned group. We bring more than 150 years of collective experience. I serve as our Chief Investment Officer, essentially acting as an executive overseeing all aspects of our investment program, strategy implementation, communication, and regulatory compliance. And I've worked in the industry for over 30 years, and I've held roles ranging from buy-side equity analyst to portfolio manager, and now Chief Investment Officer. But joining me today is among my most trusted colleagues at McKinley Carter, another seasoned veteran, Dave Nolan. He is a senior investment strategist at the firm, and he chairs our investment strategy committee. And he continues to meet the needs of individual clients as well. David brings some 40 years of experience, primarily as a mutual fund manager and individual portfolio manager for a large regional bank. We love it when he dives deep into the weeds and details, if you will, on a variety of issues. Today, considering the relatively limited amount of time we have to address lots of important issues, I'll do my best to keep us both on track. I do want to close this introduction with one other point, thinking about the way our process, if you will. Let's talk about that briefly. How do we manage client portfolios? And then we'll turn to what do we see in the world. Our work begins with long-term strategic allocations. In a sense, it's the math and science behind investments. What is the most efficient construction of a portfolio to meet various investment needs, from aggressive growth to very conservative? And then we take the insights of our 6 investment strategy team members, and we'll make tactical deviations based on things that we see in the markets, where we see an opportunity over, say, a 2 or 3 year period to overweight or underweight in any particular ways. And then we turn to investment security selection, and we're always focusing on the lowest cost way of implementing and managing investment portfolios, particularly when we're dealing with relatively modest capital market assumptions. One of the most important ways is for our largest clients, we'll manage individual equity and fixed income portfolios. And for many of our other clients, we're going to emphasize the use of index funds and ETFs and institutional class mutual funds. It's a variety of ways to keep costs down and keep client investment returns up. But let's turn to the topic at hand, if you will. We want to talk a little bit about the economy, talk about portfolio construction. What have we done, and what do we plan to do for clients? Probably the very first thing is, and by the way, I'm envisioning this as a bit of a Q&A. David and I talk, seems like every other day, on a variety of issues. So this will be a conversation that he and I would typically have. Let's talk about the current state of the economy, inflation, interest rates. There are a lot of varying beliefs about where things are headed. And I think it's important for us to share with you, what do we observe? And I think one of David's favorite lines is, what do we know? And what don't we know? David, if you want to kind of walk us through some of these current themes and share some of your insights, we'd appreciate it.
Sure. Well, thank you, David. When we think about market themes, 3 primary themes that we're operating, under at this point, and the first one, which we've been clear all during the course of this year, that we do not feel that we're in a recession. But there's evidence now that one is becoming much more likely in 2023 due to the actions of the Federal Reserve increasing interest rates. So we don't think we're there yet, but we're very likely heading towards one in 2023. The next theme is that from our perspective, inflation data appear to be in the process of peaking. We're seeing a lot of evidence to this effect, and we think that this peaking inflation data will become more and more evident and that this will lead the Federal Reserve to pause their rate hikes in early 2023. And then the third theme is that there's no question that earnings growth is slowing, and that bond yields, because they've come up so much this year, that they're now very competitive with the stock market. And so these three themes sort of dominate our actions in the market. David was mentioning, what do we know at this point? And we know quite a few things, and we'll go through some of these, and then we'll address those things that we don't know. And the first thing that we know, certainly, this has been obvious to everyone, is that this has been a very poor year for both stocks and bonds. In fact, in the last 90 years, there have only been 3 incidents of stocks and bonds being down at the same time. So this is very unusual, very rare occurrence that we've experienced this year. The next thing that we know is that interest rates are up substantially this year. And you can see on the bottom line indicates where we were on December 31st of last year. And the blue line that's above that indicates where we are now. So it's been a dramatic change in rates, and especially on the short end, the 3-month bills and the 1-year T-bills, those have gone up, very dramatically from the end of the year. Also, we have said for quite some time that we do not feel that we've been in a recession this year. We don't feel that we're in one now. Actually, there was an updated estimate just today on the third quarter GDP, and it's a positive 2.9%. So certainly not typical of what you would see in a recession where the number would be negative. Next, we know that wage growth continues to be very strong, and that unemployment is historically low. This is something that we're certainly watching to see. Will there be upcoming releases of the unemployment releases, and so we'll be monitoring those to see if this trend is changing. But right now, certainly wage growth and low unemployment does not really correlate with a current recession. The other thing that we know is that global economies are in contraction. In this particular chart, everything that's yellow or orange is a negative. It's a contraction. And green would be expansion. So you can see if you look off to the far right that clearly it's more sort of that yellowish orangish color, indicating that all across the globe that countries, whether it's manufacturing or services, that they're in contraction. So this is something else that's it's a given at this point.
It's interesting on that slide how quickly we had green, green, green. Each of those columns were quarters, but then, boy, when you look at September and October, how quickly we see yellow and orange and red showing up.
Absolutely. I mean, it's been once again, it's been a global phenomenon. It's not just in the U.S. So everyone's sort of in that same pattern of contraction. The next thing that we know is that the leading economic indicators have turned negative year over year. They were turned negative a couple months ago, and they've become more negative in the most recent release, which was in October. So when these numbers, when that blue line is below 0, as you can see on this chart, when the blue line is below 0, that means that once again, sort of confirming that we're in a contractionary phase. And what else do we know? We know that inflation, while certainly coming down, inflation is still, very much above the Fed's 2% target, and the 2% target is related to. So most people are familiar with the CPI, not as familiar necessarily with the PCE, which is what the Fed looks at, and that's the personal consumptions expenditures. And so we're waiting to see if this number starts to ease back, but right now it's significantly above the Fed's target, indicating that the Fed will still feel inclined to raise rates. Also, what do we know recently? The Consumer Price Index, the sort of the headline number that everyone is familiar with, that sort of what people associate with inflation, that this number seems to have rolled over. As you can see, that it peaked out earlier this year and is now starting to head down. So we'll have to wait to see if this trend continues. But right now it appears as though that's the case. Also, commodity prices, global commodity prices have been falling very sharply since the summer. In some cases, there are certain commodities that peaked in the spring, others that peaked in the summer, but you can see when you look at the orange line to the far right, you can see it's in a clearly in a downtrend. So this is also encouraging. And the other thing that we know about the economy is that the economy will ultimately affect earnings, corporate earnings. And these earnings projections have continued to decline. You go back a couple of months ago, and the projections for 22 and 23 were noticeably higher than they are now. And these have come down. Doesn't matter whether it's the large caps, as you see in the S&P 500, the small caps, international developed or emerging markets, all these numbers have been steadily coming down. So this is also something that is a known. And the US dollar, which has been affecting these earnings because about 40% of the sales of the S&P 500 companies comes from overseas. And so when you think about the impact that a strong dollar has on the earnings overseas, it definitely has a negative impact. So as long as you have a very strong dollar, then that will continue to be a drag on corporate earnings. But the encouraging thing on this chart, as you look to the far right, you can see that that too seems to have rolled over a bit. So we'll be monitoring this trend because this will be very impactful for the projected earnings for 23. And we know that the market, while not expensive at this point, because the market has had this sharp pullback, the market is no longer a good value versus corporate bonds. This chart is basically the red rectangle is emphasizing where we are historically with the valuation of the stock market compared to the yield you could get on a 10-year corporate bond. And what we've seen over the last couple of years is there was a big advantage to being in stocks versus bonds. That advantage now has gone away. So right now they're more on sort of we'll just call it equal footing. And so the good value that you were experiencing in stocks is not as much as it was here over the last couple of years. And mentioned that I showed before the CPI previous chart where we saw that it was rolling over a bit, and which is an encouraging sign. Another thing that's also an encouraging sign is that inflation expectations, which is shown in this chart, you can see that they peaked out early in the year and they've been steadily coming down. There've been sort of fits and starts, but in general that trend is headed down to where inflation expectations are now back to where they were in the early summer of last year. And another thing that has been in the news quite often is the global supply chain and the pressure that we experienced in terms of the backlogs, things coming from China and overseas. And this index called the Global Supply Chain Pressure Index is a measure of a lot of these factors. And as you can see to the far right on the blue, you can see that that pressure index has also rolled over considerably, which is also an encouraging sign. And then we get to those things that we don't know. And these are important as well. The first thing that we don't know is, will the economy go into recession? We think that the odds are certainly increasing that that's going to happen, but we don't know for sure. We also don't know that the economy, if it does go into recession, will be a deep recession or will be a mild recession. Right now, it appears as though if it does go into recession, it'll be mild, but we don't know for sure. This particular chart is historically had a really good reputation as something that will forecast a recession within about a 9-month period. And this is when the 3-month T-bill, when that rate exceeds the yield that you could get on a 10-year Treasury bond. And because what that's signaling is that the markets, the long bond, the 10-year, when it goes down, the market's sensing that the economy is slowing dramatically, and this is a prelude to a recession in many cases. And the recession you can see on those more shaded areas in this chart. But to the far right indicates that the 3-month bill is now pretty considerably above the 10-year Treasury bond. So that has had a really good track record of forecasting a recession. Once again, we don't know whether it is going to be mild or whether it be something more severe. Something else that we don't know is what will earnings look like. We talked about the economy is slowing. Global economies are in contraction. So we're not completely clear on the impact of corporate earnings. Will it be a dramatic impact or will it be a mild impact? Thus far, the impact has been mild, but we're continuing to monitor this. The one thing that we've seen here, I mentioned earlier that the earnings estimates have been coming down pretty steadily this year. And as we think about where the market is projecting next year only a 3.1% increase in earnings. So a pretty mild year, but still up. And so that's the the estimates that we're currently getting. But for this year, even though you see a 4.9% in that green by 2022, if you were to take away the benefit of the earnings of all of the energy companies. So when we think about energy companies are doing really well because oil prices have been high this year. If you remove the energy sector from the S&P, then the actual earnings for this year, the projections are for a negative 2.1%. So 100% of the gain in earnings this year is related to the energy industry. So something else for us to continue to monitor. The third thing that we don't know is in terms of the actions of the Fed. When will the Fed stop raising rates? We think it'll be in the spring, but we certainly don't know for sure. No one really knows. And will they overshoot on rate increases? And by overshooting, we mean will they continue to raise rates far above what the market wants them to do to control inflation in order to drive inflation down to their ultimate target? And that's one thing that we don't know. If inflation, in other words, if inflation goes from, let's say, 7 or 8% down to 4%, is that something that would cause the Fed to stop raising rates, even though it's still well above their target? Now, the Fed believes that inflation will drop next year. This chart, when we highlight with the red rectangle, shows a steady drop in the PCE inflation expectations that the Federal Reserve has. So they believe that their rate increases will be effective. And but this is something else that we don't know and they don't know for sure in terms of the ultimate impact.
Before we transition to changes we've made, I think it would be worthwhile. I've given a couple of these talks here in the last couple of months, and one of the points that I've tried to emphasize to people is the differentiation between economic cycles and market cycles. In 2022, we saw a material decline in both equity and stock markets, as David has spoken of. But then we talk about on the horizon these anticipated declines in the economy. And I maybe chalk it up to we don't know definitively, but we can make a professional assessment that we believe the worst of the market declines are behind us in 22, but in 23, headlines are going to be rough. Unemployment's rising, housing starts are off. There's going to be a variety of economic data points that are negative, but that's already discounted into the marketplace. We actually have a pretty optimistic look for the market in 23, although the economy will remain soft. Anything you want to add to that?
Yeah, absolutely. And we'll talk about our outlook in just a minute. But yeah, I agree completely that the market tends to react on where it thinks things will be 6 months from now, 12 months from now. So we tend not to get focused on the here and now as much as the making projections for, as I said, where we'll be in 12 months' time. And we could be in a markedly different place in 12 months' time than where we are now. In that period of time, you could make the case that the Fed would have stopped raising rates and will have stopped for a while. And if we have a mild recession, then the earnings drop may be minimal, and then the market starts to reflect that. So it certainly could be, could have a very positive outcome as we move forward. Sure. But when we think about the changes that we've made this year in the middle of all of this.
And actually,
Oh,
don't just look at 22 changes, right? I mean, of course, I'm deeply involved in the strategy committee looking back. I mean, changes we made in 20, 21, 22. I mean, I think I would go look back a little further even, and just kind of give us a summary of the specific changes that have happened, or I shouldn't say specific, concepts, themes of changes, because I think we did a lot to prepare our clients for this downturn.
Oh, absolutely. And when we think about the some of the changes that we've made over the last couple of years, actually, probably a couple of years ago, we became more defensive in our bond portfolios. And what does defensive mean? Defensive means that when you think about a term called duration, which is basically just the risk that is involved in a bond portfolio. And it tends to mean that if you have bonds that aren't as long in maturity, then shorter bonds are less risky than longer bonds. And so we have had a shorter length of our maturities in our bond portfolio for actually quite some time, the last couple of years. And so we've maintained this defensive posture, which has, all bonds have gone down this year. So you couldn't really hide from that. But what we tried to do is mitigate risk by having these shorter durations. And that's been in place in our portfolios all year. And so that certainly helped. Another thing that we've done is earlier this year, we moved into some investments that focus on free cash flow yields. And so when you think about what this year has told us, that earnings are really important. The stocks that have suffered the most this year are the ones that were very high valuations, had little in the way of earnings growth. Most of their earnings growth was projected 3, 4, 5, 6 years out. And so we focused with some investments this year that are sort of the here and now. They have high free cash flow yields today. And so that has helped our portfolios. Also earlier in this year, because we were concerned about what was happening with the war in Ukraine and issues of the stronger dollar. And a stronger dollar, we talked earlier, stronger dollar has a big negative impact on earnings of U.S. companies, but it also has a huge impact on a U.S. investor, how your international holdings are doing. So earlier this year, we reduced our international allocation by 20% because we wanted to mitigate the impact of the stronger dollar. Also, we added energy stocks, talking about earlier, this year, 100% of the earnings gain in the S&P 500 is from the energy sector. So earlier this year, we added some energy stock exposure because we wanted to have more exposure to that area that was seeing the best earnings growth. And then just recently, we started adding some growth stock exposure. Growth stocks have done very poorly this year. Value stocks, which tend to be the more cyclical stocks, think of financials, think of industrials, energy, those type of names. We started to add back some growth names because many of these growth stocks have been severely punished this year. And so we think there's some real opportunities. And as inflation peaks, as we think it is, and interest rates peak, then we think that the market will start rewarding these growth stocks again, because historically they do very well when interest rates are declining. When we think about what's our outlook, David was alluding to this earlier, and we know a couple of things through history, and so this informs our current positioning, that despite what's going on now in the economy, that the market tends to bottom well before you come out of recession. So this chart highlights a number of recessions that we've seen in the past and what the stock market has done during that period. So it tends to drop towards the beginning of the recession and then goes through a recovery as you're in the recession. So at this point, we don't know officially that we're going to have a recession, but it's something to keep in mind that as the market is working its way through it and looking out 12 months, you won't always have a poor market, even though you may be in the middle of a recession. So history can guide us on giving us a reason to be more optimistic. Also, what does history tell us about when sentiment is extremely negative? And that's been the case this year, just with the inflation and the issues with the Russian-Ukrainian war. And pessimism has been very high this year. And so this chart when you look off to the far right, especially, and you see the blue dot indicating where we are currently in terms of consumer sentiment, it's still very low. And historically, 12 months after these low points in consumer sentiment, the market tends to be up pretty sharply. So, we don't want to say that that history repeats in the same way every time, but it's a pretty good guide that when things go to extremes, as we are with sentiment, that 12 months later things have improved markedly and the stock market has done quite well. Also, this is a real key factor for us in terms of our us being more optimistic than pessimistic at this point. Is history also shows us that when inflation peaks, which we think is in the process of happening now, that if you look at the returns 12 months out, those returns for both stocks and bonds tend to be quite good. Every pattern is a little bit different, but on average, it's been a very good performance, a very good period of performance for both stocks and bonds. So that's also an encouraging sign that's informing our degree of optimism. So we think about what changes might we make. We said what those things that we know that are happening right now, what are those things that we don't know that are happening? And so as we think about a low inflationary environment and an environment where interest rates are dropping, what changes might we make as we go into 23? And so we talked before about we've started to increase our growth stock exposure. And if the economy continues to decelerate, which would bring interest rates down, that tends to be a better environment for growth stocks. So we may very well increase our growth stock exposure even more than we have here recently. Then a strong dollar. We talked about the strong dollar impact on how that's really hurt international equities. And if we see a peaking of the dollar, which right now there are early signs that that's happening, then that may lead us to increasing our international equity exposure. And then the third thing that we may very well see is that as interest rates peak and inflation peaks, then there will be an opportunity to lock in some of these higher rates. So we talked about duration earlier. So we may start to lengthen the duration of our portfolio to lock in some of these higher rates. And this also applies to dividend paying stocks. We've already been emphasizing some dividend paying stocks earlier this year with the cash flow yield investment that I talked about. But going forward, this would also thematically dovetail with what we're doing and trying to lock in bond yields.
Thank you, David. I know we're short on time today. I want to try to bring us home here. I want to just thank everyone for participating, and I'll just close with a handful of remarks. One is that in addition to the stocks and bonds that David and I have been speaking about, the reality is we've been adding alternative investment opportunities to portfolios where appropriate. These less correlated to stocks and bonds, and they may include private equity, direct lending, private real estate. If you haven't yet had a conversation with your advisor, please do. They're not appropriate for all, but for those that we think so, we actually are making those introductions. We're thankful to have the resources and the desire to help clients like you. We're sorting out what's going on in the world and, of course, in your portfolio. Sessions like today are just one of the many ways that we live out our commitment to help you master your wealth. That's our relatively new company tagline. But mastering your wealth means having the confidence to live your life, taking care of the people and interests that are important to you. We take into consideration efficient portfolio management. It's of course an important part of of this strategy, but it nests within an overall total financial strategy. How do we help families achieve their life goals? Our advisors are trained to help you kind of clarify a vision for success, inventory your assets and liabilities. We help you ascertain expectations for cash flow into and out of your portfolio, and considering expected risks and returns for a portfolio strategy will help you assess the probabilities of success. If you're not comfortable with your current situation, even if you're already a client, and if you're concerned about the outlook, don't hesitate to engage any of us in conversation. We'd love to help you. We'd refresh your analysis of your unique situation. And anytime you're interested, we'll share with you our client book. Many of the slides we use today are part of something that we produce every month to prepare our advisors for client conversations. We will address economies, markets, and of course, portfolio strategies. We'll close today with our genuine thanks. Thanks for joining us. We invite you to share our approach with others you think might find it valuable when they're considering their own financial situation. Thank you so much. We look forward to seeing you again soon.